By the end of this section, you will understand what are the 5 major U.S. fundamental indicators. You will understand how GDP affects a country's currency. You will understand the importance of balance of trade in forex, and you will learn about the importance of the Philly Fed index. Now, here are the 5 major U.S. fundamental indicators. We have gross domestic product, non-farm payrolls, balance of trade, Treasury International Capital Survey, otherwise called TICS, and we have the Philly Fed Survey, also called the Philly Fed Index. Now, each of these indicators gives us insight into the state of the U.S. economy. When they are combined, they give us an overall view of the U.S. economy and as a result, help us to identify the future direction of the U.S. dollar. And remember, the primary driver of market sentiment is interest rate. So all the economic data that is disclosed is used as an indicator to assess the likelihood of the central bank raising or lowering interest rates. Okay? So always remember, the primary driver of market sentiment is interest rate. How likely is the central bank to raise or decrease interest rate? If we have good GDP, good non-farm payrolls, and economy is going good, then we can expect the central bank to increase interest rate. And whenever the central bank increases interest rate, the currency of that central bank will rise. And this is simply because investors will invest in a country that is increasing interest rate because they will get more return on their investments. Okay? It's simply because of the transfer of money from countries that are decreasing interest rate to a country that is increasing interest rate. So that's the main reason why whenever a central bank increases its interest rate, the currency of that central bank increases in value. So always remember that interest rates are the primary driver of market sentiment. Domestic product. Now, GDP refers to the total value of all goods and services produced within a country within a given period. Now, generally speaking, GDP is a measure of production in a country. If GDP is going up, production is going up, and the country is experiencing economic growth. However, GDP is a lagging indicator and is released quarterly. Now, what do I mean by lagging indicator? A lagging indicator reflects the economy's historical performance, and changes to these are only identifiable after an economic trend or pattern has already been established. Okay, so the GDP is a lagging indicator, while leading indicators often change prior to large economic adjustments and as such can be used to predict future trends. Examples of leading indicators are retail sales, market PMI, because these change prior to large economic adjustments, while examples of lagging indicators are GDP and consumer price index, the CPI. Okay, these change after a general trend in the market. Now, rising GDP is a positive sign for an economy. And this is because rising GDP signals growth, and as the economy grows, there is increased inflation. Remember, the main tool used by central banks to control inflation is raising interest rate. So whenever there is increased inflation, this is good for a country's currency because as a result of this, the central bank will need to increase interest rates. Okay? And central banks need to increase interest rates because rising inflation can stop the growth in GDP. And this is because if prices are rising too rapidly, the cost of goods and services may start to exceed demand. And whenever goods and services start to exceed demand, this will result in excess inventory, and excess inventory will lead to losses, which will result in producers cutting costs, which will result in loss of jobs, which will eventually result in a decrease in retail sales, which will eventually lead to decrease in GDP, and decrease in GDP will eventually lead to the central bank decrease in interest rates. So everything is connected, which is why it's important to understand how these fundamental announcements correlate, so you can see how the result of these indicators affect the central bank and interest rates. And remember, higher interest rates make money more expensive to borrow and thereby reduce spending by those producing goods and services, okay? Lowering interest rates have the opposite effect. We will take a closer look at this when we get to interest rates. But remember the general concept. Higher interest rates make money more expensive, while lower interest rates make money cheaper, and hence encourages borrowing and spending.